All right. Well, seems to be too loud. Maybe I can tune down a bit. Okay, so we will have the test at around, I think around 8 o'clock. Okay, so we will start the test at around 8 o'clock. And before that, we have to finish this set of PowerPoints and hopefully the tutorial exercise also. So let's begin. Okay, so today's last topic of this subject would be carbon tax and emission trading schemes. Okay, two types of market-based approach. Okay, so after this lecture, I hope that you will be able to describe the key design factors, pros and cons of carbon tax, and also the mechanism, pros and cons of the ETS, the emission trading scheme, and be able to compare carbon tax and emission trading scheme. Okay, so before we move on to the carbon tax and emission trading scheme, you have to understand that there are two types of mechanism for controlling carbon emissions. And these two types of mechanism would be command and control mechanism and market mechanism. So for carbon tax and the ETS will belong to the market mechanism. So what is command and control mechanism? So it specifies limits for emissions and or mandates that specific emission control technologies that must be used. So for command and control mechanism, it would be like a regulation. Okay, something mandatory, something that an organization, a company, the public must follow. Okay, for example, so in the recent years, the government has passed the law that when you buy some takeaway from the restaurant, from the canteen, so it is not allowed to give away the plastic fork or plastic spoon, right? So these are something that the restaurant, these catering outlets must follow. Okay, otherwise they will, offend with the law. So these kind of mechanism, okay, like for banning the use of plastic cutlery. So this is to reduce the impact to the environment, right? Reduce the solid waste. So these are some examples of command and control mechanism. Okay, so like a regulation, something mandatory that you must follow. Okay, so no choice. Okay, even you have to, you want to pay. Okay, I want to pay. No. Okay, so you can only follow these regulation. So example, apart from that, banning of plastic fork, plastic spoon, plastic cutlery. Another example is a regulatory framework that includes emission limits that a power plant must comply with, and technology upgrades mandated by the government. So maybe from now on, okay, so all kind of power plants must apply some kind of technology. Okay, maybe must utilize solar PV panel for generating power, and no one can burn fossil fuel anymore. Okay, then this is a kind of regulation, something mandatory, and the power plant company must follow. Okay, so this is the command and control mechanism. Or maybe the government sets some emission limits, and everyone must follow. Okay, the power plants or some big emitters must follow. Okay, so this would be the command and control mechanism, like the law. Regulation, okay, no choice, everyone must follow, like a one-size-fits-all, okay? So everyone, okay, every company, no matter what is the type of business, or maybe I don't care about what kind of technology, or maybe what kind of business, okay? So you must reduce the emissions to a certain standard, otherwise you will offend the law. Okay, so this is command and control, regulation, okay, no choice. And the other type would be market mechanism, okay, market mechanism. It is an economic approach that focuses on utilizing economic incentives and market mechanism to encourage business and individuals to reduce their carbon footprint. So example would be carbon tax and emission trading scheme. Okay, so for carbon tax, so you need to pay for a tax according maybe the carbon content of the fuel that you consume, maybe the carbon emissions due to the energy that you consume, or maybe other example. So these are the tax that you need to pay. So you have the choice, you have the freedom to consume more energy and then to emit more carbon. It's just that you have to pay more. All right. And for the emission trading scheme, you can reduce your emissions and then sell the credits to the market, or you buy the credits, you buy the allowance from the market. So you pay the money in order to satisfy the requirements. So you have the freedom to either reduce your emissions or to pay. All right. So the market mechanism and the command and control mechanism are totally different. Okay. Command and control, that would be something mandatory. Everyone must follow. And for the market mechanism is to provide some financial incentive. So if you don't want to pay so much for the carbon tax, then you reduce your emissions. Okay, maybe you choose another kind of renewable fuel, okay, or low carbon intensity fuel so as to reduce your carbon tax. And for the emission trading scheme, you may invest in some clean technology, reduce your emissions such that you can sell the allowance to the market and make money. Okay, so in the market mechanism, it provides some financial incentive to attract the organization to reduce their carbon emissions. So this is a table comparing the command and control mechanism, okay, just like bending, or maybe another example is the bending of use some kind of refrigerant, okay, to reduce the ozone depletion, okay, like the HCFC, okay, bending the use of this kind of refrigerant so as to reduce the ozone depletion in the atmosphere. Okay, so even if you have much money, okay, I want to pay extra money so that I can use this kind of refrigerant. No, not allowed it. Okay, something regulation. Okay, so you must follow command and control. And the market mechanism, like the carbon tax emission trading scheme. So for command and control mechanism, for the implementation, so the government specifies how firms shall act, and the firms must comply or it will be penalized. Okay, so like another example would be the emission of some air pollutants from the vehicles. Okay, so maybe the government would mandate that every vehicle should install some equipment, apply some technology to reduce their air pollutants from the exhaust. Okay, so everyone must follow, otherwise you will be offending the law and be penalized. Okay, and for market mechanism, the government sets the target but allow the firms to decide the actions and individual targets. So the government sets the reduction of the emission target, and then the firms will decide whether you apply some clean technology, reduce your emissions, or you buy the allowance from the market. Okay, so the government provides financial incentives to attract the firms to reduce their emissions. Okay, so market mechanism is always about financial incentive. Okay, because it is from the experience, okay, the previous experience that people will reduce their emissions very often when there is some financial benefits. Okay, otherwise they will just continue as usual. So for command and control, the cost, excessive administrative costs with uncertain potential costs to individuals. So if you mandate every firm to apply some technology, or maybe they must reduce their emissions to a certain level, then the cost of these reduction could be very high, okay, because it is a one-size-fits-all mechanism. So no matter what is the type of your business, and no matter how difficult is your company to reduce your emissions, so we have the same line for you to fulfill, okay, then the cost, the overall cost of carbon reduction could be very high, and the administrative cost could also be high because it is the law. So you have to find some operators, the governments have to check if everyone has complied with the law. So it will, like a large cost implication. And for the market-based, lower administrative costs. For effectiveness, so the command and control mechanism may set a too lenient, okay, too low standard, or maybe too stringent standard. So it's very difficult to set the appropriate line of reduction. And for market mechanism, the best alternative can be chosen to achieve the ideal target because it allows the market to decide which technology to be used. And that technology probably would be the cheapest, okay, allow the market to decide. Cannot regulate the continuous high emissions of top emitters. So for command and control, so the top emitters would always be the large company, okay, big company, and probably they would have some political or some social influence. Okay, so maybe for those top emitters, so they would claim that, so if the government has passed that law, then maybe my company will close, and it will imply that many people will lose their job, okay? Or maybe they have some political impacts to the people in the government. So it could be quite difficult to regulate the high or the top emitters for using command and control mechanism, okay, because you are affecting the business of those large company. And for the market-based, provides incentive to reduce more emissions in lower costs. So for market-based, the government provide financial incentives, right? So if the companies see the opportunities to earn money, then they will invest in those clean technology. Okay, for command and control, discourage technology innovation. So as long as they have complied the minimum requirement, then there would be no benefits to further reduce the emissions. So they will not invest in better technology. Okay, so as long as they comply with the regulation, comply with the law, then no incentives to further reduce the emissions. But for the market-based, it encourages technology innovation, because if they can invest in these clean technologies, reduce their emissions, then they can make money by selling these allowance to the market. Okay, effect on public involvement, uncertainties to the public. So it could be quite uncertain to the public. Okay, like so if you are mandating the law, then the public will have a lot of concern about its operation, about the details. And for the market-based, the amendment procedures and the costs are easily understood by the public, like the carbon tax. Okay, so based on the energy consumption in your electricity bill, then it's very easy to follow, very easy to understand. So example, minimum level of embedment or installation of certain kind of equipment, okay, must reduce the level to a certain level, must install that kind of equipment in your facilities. And for market-based, like carbon tax and the ETS, emission trading scheme. Okay, so this table compare the difference. So let's talk about carbon tax. So this lecture will focus on carbon tax and the ETS. So for carbon tax, it is a tax levy on the carbon content of the fuels. And the fuel would be the fossil fuel, right? So like the coals, the oil, gasoline, natural gas, and generally in the transport and energy sector. Okay, but it can be applied to some other sector as long as they have the mechanism to quantify the emissions. So it is one of the policy available to governments to reduce the greenhouse gas emissions. The purpose of carbon tax is to reflect the true cost of burning carbon. Those costs are borne by those who suffer from the effects, such as the homeowners, farmers, ultimately the government. Okay, so by burning the fossil fuel, releasing carbon emissions to the atmosphere, there will be certain environmental impact. Okay, the impact may affect the homeowners, may affect the farmers, okay, maybe affect the harvest of certain kind of crops, and ultimately affecting the government income. Okay, so these impact will be internalized to the carbon content of the fuels. So that's the carbon tax. So carbon tax makes sure companies and consumers pay the external costs that they impose on the environment, on the society. So basically, it is the polluter pays principle. Okay, you pollute the environment, then you pay. Okay, if you pollute more by emitting more carbon dioxide, then you pay more. Okay, so the more you emit, the more you need to pay. So that's the carbon tax. This is a video about carbon tax, so I will leave it to you to watch after the lesson. So to charge the carbon tax, we need a tax rate and a tax base. So the tax base could be the relative carbon content of the fuel. Okay, so the fuel could be coal, could be natural gas. So comparing coal and natural gas, coal would have a larger carbon content. Then if you burn coal to generate electricity, then you may have to pay more. Okay, so based on the relative carbon content of the fuel, or the tax base could be the absolute carbon dioxide or other greenhouse gas emitted. Okay, so by burning certain kind of fossil fuel, it will emit certain amount of carbon dioxide and greenhouse gas emissions, like using those emission factor. Okay, so the more you emit, the more you pay. Okay, or the energy content, so how much energy you spend or you consume, okay, maybe based on kilowatt hour, kilojoule, okay, the amount of energy. The market price per unit of energy, or the volume of energy produced for both fossil fuel and non-fossil fuel. So these are some base for calculating the carbon tax. And how about the unit rate? Okay, like the tariff, okay, like the utility bill, what is the unit rate for the tax? So the rate would be determined according to the marginal cost of carbon emissions, with adjustment on the basis of different energy products and different user. So I hope that you still remember the term marginal cost of carbon emissions. So in the lecture about the carbon economics, we have learned how to calculate the marginal cost of carbon. So how much do you need to pay for reducing every ton of carbon dioxide? Okay, and we have learned how to draw that carbon embedment curve, right? So some technology may have higher cost of reduction. Some technology may even help you to save money. Okay, so that cost would be a negative value. So these are the marginal cost of carbon emissions, and the carbon tax should be related to these marginal costs. So according to the requirement of achieving proposed emissions reduction. So according to that embedment curve. So the government may refer to that carbon embedment curve, and then according to their target, okay, how much carbon do they need to reduce, and then set the carbon tax rate. Okay. So if the government only need to reduce a small amount, then the carbon tax could be cheaper, okay, because the company can utilize cheap carbon reduction strategies and will be enough to reduce their emissions to a small value. Or if the government is very ambitious, okay, they want to reduce a lot of carbon, then it means that the company needs to apply some expensive technology. And in this way, in order to push those companies to apply those technology, then the carbon tax needs to be more expensive, because those advanced technology would be costly to apply or to operate. Okay, so the carbon tax at the same time should also be more expensive. So the quantity or the value of the tax rate will be related to the marginal cost of carbon reduction, okay, like that carbon embedment curve, and also the targets of carbon emission reduction. Okay, the scope. A carbon tax could be levied on the carbon dioxide emissions content of the fossil fuels. The point of taxation. A carbon tax can be levied at any point in the energy supply chain. Upstream, like when you import coal, when you import natural gas, when you import oil, then you can be charged based on the carbon content of the fuel. Then this is the upstream, okay, supplier of the coal, supplier of oil, and they have to pay the carbon tax. Or maybe midstream, electric utilities, or downstream, energy using industry, household, or vehicles. So when you consume electricity that is generated by fossil fuel, then you have to pay for the carbon tax. Or for your vehicles, you're using fossil fuel, gasoline or oil, then you pay for the carbon tax. Okay? Economic theory suggests that a carbon tax should be set equal to the social cost of carbon, and it should also rise over time to reflect the growing damage expected from the climate change. So the carbon tax value should be higher and higher, okay, in order to reduce the emissions. Okay, so the government charge carbon tax. So when you consume electricity, everyone pays for the tax. Then it means that the government will earn a lot of money, right? So these are the revenue generated by enforcing a carbon tax. So the revenue can be used by the government to invest in climate purpose or reduce existing tax on labor and capital, creating a revenue neutral approach. So the revenue earned by the government can be invested in the clean technology, or it can also be used to subsidize some low-income families. Okay, directing a certain percentage of revenue from carbon tax towards low-income households to compensate for increased energy costs can help ensure that the tax does not disproportionately affecting the poor. Okay, so for the rich people, paying a small amount of carbon tax is nothing, okay? But for the low-income family, maybe it would constitute a large percentage of their income. So the revenue generated by the carbon tax should be used to subsidize those low-income families. Okay, problems of carbon tax. So just like earlier in Hong Kong, the government proposed to enforce a municipal solid waste charge, right? So the more rubbish that you throw away, then the more money that you have to pay. So that is a kind of tax on the refuse or on the garbage. And the government has already withdrawn this tax. And so for carbon tax, it may face the same difficulties. So general public always opposed to new tax. So no one want to pay that money, particularly those groups adversely affected. So in the US, a federal level carbon tax proposed in 1993 failed due to a strong public opposition because of significant regional difference in the context, in the extent of relying on coal and public transport development. So maybe in some region, the public transport network is very poor. Okay, I cannot take the public transport. There is just no bus, no train, so I can only drive. And maybe by that time, you can only use the fossil fuel. So I am living in this region and I have to drive and I have to pay a expensive carbon tax, which is not fair. Okay, because in another region, in the same country, maybe some people, some region has a very well public transport network. Okay, then they don't need to pay for expensive carbon tax. So that's why by that time the carbon tax was facing many difficulties. And the first EU-wide carbon tax was proposed in 1992, but then rejected by several member states. A lower tax rate can be set to reduce public opposition, increase political viability, and give time for adjustment. So in the beginning, the tax rate must be lower. Okay, otherwise there would be a lot of resistance by the public. The government not only has to consider the marginal cost of climate change damage, but needs to balance the economic development and public options. So not just about the carbon embedment curve, the amount of carbon that you want to reduce, but you have to balance the economy and also the effects to the public. Okay, some pros, support of carbon tax. So environmental benefits. So carbon tax provides financial incentives for business and individual to reduce their carbon emissions. It encourages the adoption of clean energy and sustainability technologies. And it generates revenue. And the revenue generated can be used in investing renewable energy projects, energy research and development, or used to subsidize clean technology. And it may also stimulate job growth in the clean energy sector, okay, because the government is now subsidizing this clean technology. So it may stimulate the job growth and the job market in that sector and contribute to the transition to a low carbon economy. And the cons, okay, a sudden increase in carbon tax would shock the economy. Higher energy costs resulting from the tax can lead to increased production costs, reduced competitiveness, and potential job losses in certain sectors, may discourage investment and economic growth. So these are some problems, because when you has enforced a carbon tax, it will highly impact to the economy. Everyone needs to pay more. Then no one wants to buy other extra things. Okay, potential of carbon leakage. So companies may relocate their production to regions without carbon tax. Okay, so maybe they move their manufacturing plant to Vietnam, okay, without the carbon tax. Okay, then this is the carbon leakage. Okay, resulting emissions simply being shifted rather than reduced globally. So this can undermine the effectiveness of a carbon tax in achieving emissions reductions in a global scale. And low-income households may bear a disproportionate burden of increased energy costs, potentially intensify income inequality. It penalizes those who cannot switch to alternative energy sources. So these are some resistance, some problems faced by the carbon tax. And these two are the trend, okay, or the relation between the emissions and the carbon tax value. Okay, so cheaper carbon tax, more expensive carbon tax, and higher emissions, lower emissions. And it is found that the countries that levy higher effective carbon tax would be less carbon incentive. So if you enforce a more expensive carbon tax, then generally the overall carbon emissions of that country will be lower. Okay, so it is like a inversely proportional. Okay, so the higher the tax, the lower the emissions. And here, okay, this one is road sector traffic, and this one is non-road sector. Okay, the similar trend. Okay, to be most effective, the carbon tax should be used in conjunction with other measures, like end government subsidies to coal, oil, and gas companies. So the government should no longer subsidize to these fossil fuel companies, gas companies, stop the subsidies. and then subsidize the renewable energy like the wind power, solar power, hydropower, increase energy efficiency standard, okay, more stringent standard. Like in Hong Kong, the MSD will update the building energy code, okay, or we call that the code of practice for energy efficiency of building services installation. And for every new revisions, the requirement will be stricter, okay, more stringent. Build more public transportation, okay, so that people don't need to drive themselves, or maybe promote the use of bicycle, or even promote walking. Okay, implement carbon emission trading. So these are some measures that should be used together with the carbon tax. Okay, the next one would be emission trading scheme. This is also a video explaining the emission trading scheme, so please watch this video after the class. A carbon emission trading scheme, or we call it ETS, okay, or cap and trade system. So cap means we limit the total emissions of carbon and allow the market to trade the allowance of emissions, so cap and trade, or emission trading scheme, ETS. It is a regulatory tool implemented by the governments to limit the release of carbon dioxide and other greenhouse gases into the atmosphere. It allows emitters to determine the most economically efficient method to reduce emissions according to their own situation. So how is that? Why the most economically efficient method will be utilized first? Okay, because it allowed the markets to, so the ETS allowed the market to decide which technology will be most effective, will be most cost effective, the cheapest technology to reduce the emissions. Okay, so the price of each allowance will be adjusted according to the cap and also the scarcity of the allowance in the market. So I will explain some examples and you will understand more by that time. So it provides the flexibility for polluters to choose either to reduce their own emissions to meet the new target, or go to the market to buy the permits or the carbon credits, the allowances, okay, the permits. So each permits or each carbon credits will allow the organization to emit a certain amount of carbon dioxide, okay? So if your organization applies some technology to reduce the emissions, and maybe it is cheap, okay, a cheap way, a very cost-effective way to reduce your emissions, then you may sell the extra allowance to the market and earn money. Okay, so in the market of the ETS, every company that can find ways, cheap ways, cost-effective ways to reduce their technology, okay, will sell their emissions allowance in the market. Okay, then other organizations which find it difficult to reduce their emissions can buy these allowance in the market. Okay, just like in some second-hand market. Okay, so if you have buy something at a low cost, okay, then you can sell that items at a lower cost in the second-hand market, right? So if I need that thing, then I will buy from you. Okay, so like the carbon emissions market. So if your company is able to reduce the emissions in a cost-effective way, okay, then you can sell these allowance in the market. Okay, so always the market price of the allowance will be adjusted according to the numbers of allowance available in the market. So in a nutshell, carbon markets are trading system in which carbon credits are sold and bought. Okay, so cap and trade. So the government cap the allowance, okay, and then these allowance will be traded in the market. So a cap or limit on the total amount of emissions by certain industry, sectors, or countries is set by the central authority. So usually the government, individual entities, okay, so companies, organizations, okay, within the covered sector are allocated a fixed number of permits, okay, like carbon credits, so permits or carbon credits, and each permit, each carbon credit will represent the right to emit a certain amount of greenhouse gas. So according to the target, according to the reduction target of that region, so the government will determine how many credits to be distributed to each entity. Okay, so the total amount of credits must be smaller than the total emissions for business as usual operation. You know what I mean? So if you want to reduce the overall carbon emissions of the region, then the allowance distributed to all the companies, okay, the total allowance must be smaller than the emissions total, right? Okay, so it set the targets of emissions, and the target must be lower than the business as usual emissions. So individuals, entities within the covered sectors are allocated with a fixed numbers of permits, credits, which represent the right to emit a certain amount of greenhouse gas. If an entity can reduce its emissions below its allocated permits, so maybe that entity, that company has a very good method or a very high potential to reduce their emissions, such that their emissions is below the allocated permits, then they can sell these extra credits to the market, okay, to those who is struggling to meet their emissions targets, because it recognizes the fact that, okay, the ETS recognizes the fact that every company, every organization will have different capacity to reduce their emissions. Maybe for some company, very easy to reduce certain amount of emissions. And maybe for another company, so if they need to reduce the same amount of emissions, maybe they cannot continue the business anymore. They have to close the company. They have to close their business. Because every individual, every different company may have different capacity, different potential to reduce their emissions. So if some companies have a high capacity, high potential to reduce their emissions, then they can reduce and sell these allowance, sell these permits to those who are struggling to reduce their emissions. So this creates a market where the price of credits is determined by the supply and demand. So if it is if there are a lot of allowances, a lot of credits being sold in the market, then it means that maybe the allowance distributed by the government is too many, okay, such that the companies maybe it's very cost, or I should say it's very easy for the companies to reduce their emissions. Then maybe next year the government has to reduce their allowance, okay, distributed to the entities. So it contributes to economic efficiency by facilitating emissions reductions where it is cheapest to achieve them. Okay, so by applying this market-based approach, this supply and demand approach, the cheapest technology, the most cost-effective technology will always be applied, be exploited first. Okay, because it is just the market, how the market works. Okay, this diagram is explaining the emission trading scheme. Okay, like here we have two companies. So for this company, it will emit this amount of emissions, and then these are the excess allowance distributed. So this big circle is the cap. Okay, so the maximum emissions allowed by this company. And then for another company, they have maybe the same, or they have this amount of cap, okay, maximum emissions. And for this company, the maximum emissions, okay, is larger than their actual emissions. So they have some extra credits, they have some extra permits for emissions, for greenhouse gas emissions. And for this company, they are emitting too much greenhouse gases, and the amount of greenhouse gases that emitted is just larger than the cap, okay, more than the cap. Then they have to buy the permits from the market. For example, buy from this company. So these are the extra permits that allow the company to emit the greenhouse gas. So maybe they can sell these extra permits to this company. Okay, so the overall result will be this company will emit this amount, and then this company emit this amount, and the total would be the total of these two cap amount. Okay, so in the end, these two companies will be able to achieve their emissions target, and the cheapest technology will be employed first. This is also another video, so you can take a look after the class. So here, this is another diagram explaining why the cheapest technology will be employed first. So like here, we have two different companies. Okay, this is a power plant A, this is a manufacturer B, and their emissions. Okay, maybe for power plant A, they will emit 500 tons of carbon dioxide, and for manufacturer B, they will emit 400 tons of carbon dioxide. And in order to reduce 100 tons of carbon dioxide, so maybe for this power plant A, they need to spend $2,000. Okay, spending $2,000 to reduce the first 100 tons of carbon dioxide. And if power plant A wants to reduce further, okay, another 100 tons of carbon dioxide, then they have to pay $3,000. And similarly, okay, if they want to reduce more carbon, okay, like another 100 tons of carbon, then they have to pay $4,000. And for this company, for manufacturer B, if they want to reduce the carbon emissions from 400 to 300, they have to pay $1,000. And if they have to reduce further of 100 tons, then they have to pay $1,500. Okay, so you can see that it is easier for manufacturer B to reduce their emissions, right? So for power plant A, they have to pay $2,000 to reduce 100, but for manufacturer B, just $1,000. And then for another 100 ton, $3,000. And then here, $1,500 only. So for manufacturer B, they have a higher potential, higher capacity to reduce their emissions. While for power plant A, they have difficulty. Okay? They would be struggling to reduce their emissions. So if you use command and control, okay, both companies need to reduce their emissions to 300 tons. Okay, I don't care how you do it. Okay, it's just that it is now the regulation, it is now the law. So you must reduce your emissions to 300 tons. Then for power plant A, they have to spend $2,000 and $3,000 to reduce this amount of emissions. And then for manufacturer B, they only need to spend like $1,000 for reducing emissions. So for the whole society, okay, they will need to pay $2,000 plus $3,000 plus $1,000, that is $6,000 for reducing 300 tons of carbon dioxide. And the unit cost of reducing 1 ton would be $20. All right? So this is for command and control. Okay? One emissions reduction target for both company. Okay? Even though even though power plant A has higher barrier or more difficult to reduce the emissions, but for command and control, we don't care. Okay? So you have to fulfill the emission target. So how about market mechanism or the cap and trade? So if there is ETS, if there is emission trading scheme, then for manufacturer B, they have a higher potential to reduce their emissions in a cheap, cost-effective way. Then for manufacturer B, they will spend $1,000 and $1,500 for reducing their emissions, and then they may sell the emissions allowance to power plant A, or maybe selling to other companies. And for power plant A, they may reduce 100 ton by spending $2,000. So comparing to earlier, so for command and control, we reduce 300 ton of carbon dioxide, right? And then the total cost is $6,000. And now by using the cap and trade system, we are also reducing 300 tons of carbon dioxide. Okay, but the cost would be cheaper. So here, 2,000. And then for manufacturer B, 1,000 plus 1,500. So the total charge is only 4,500. Okay, so the cheapest technology will be utilized first, such that the total cost of carbon reduction in the whole society will be cheaper. So in this case, $15 per ton of reduction, and earlier, $20 per ton. Okay? So here it doesn't explain how the trading will be conducted. Okay, so it shows the overall carbon reduction. It just shows the amount of overall carbon reduction. And we can see that the total cost will be cheaper if we are using cap and trade. Okay, because the cheapest technology will be utilized first. Okay, pros and cons of ETS. So for pros, the market-based approach, it provides economic incentives for business to reduce their emissions by rewarding those who emit less and penalize those who exceed their allowances. So it gives incentives in terms of money to the companies, to the business who can reduce their emissions. Okay, flexibility and efficiency. It allows business to find the most cost-effective method to comply with the emissions target. Like here, okay, these are the cheaper emissions reduction technology, so they will be employed first. Okay, encouraging innovation and efficiency in reducing greenhouse gas emissions. And it also, instead of giving the allowance for free, the government may also give out the emissions by auction. So by auctioning the emissions allowances, governments can generate revenue, which can be used for various purposes, like investing in a renewable energy project, clean technology, and supporting communities affected by the high emissions industry. Reductions of emissions. So by setting the declining cap on emissions, a well-designed ETS should lead to significant reduction in overall emissions. So the overall cap should reduce year after year, such that the emissions can be more. Okay, so the overall carbon dioxide emissions can be reduced year after year. You see what I mean? Okay, so the so the cap, the total emissions cap in a region, okay, should be reduced year after year. Okay, then there would be a significant emissions reduction. Okay, cons. Complexity and administrative burdens. Implementing and managing an ETS can be complex and require significant administrative resources. So the ETS market is something like the stock market, okay, also based on supply and demand. So the system could be quite complicated. And the ETS primarily focus on reducing emissions from large industrial sources. So usually the power plants, power station, industrial plants, those large emitters. It may not effectively address emissions from other sectors like the agriculture or the transportations. And there may also be carbon leakage. It can regulate the emissions of the country having the emission trading scheme. But the emissions can leak to another region or sector with less regulation, contributing to overall increase in the greenhouse gas emissions. Okay, this is a table comparing the carbon tax and the emission trading scheme. So for carbon tax, so the individuals or companies pay for the carbon emissions, which is proportional to the amount given off. So the more amount of carbon or greenhouse gas you emit, then the more tax you need to pay. And for the emission trading scheme, allowances are issued, which can be traded to cover the quantity of emissions. Mechanism. So carbon tax sets the price of emissions and allows the quantity varies. So the quantity would be the quantity of emissions. So I think for the carbon tax, once or in the early times when the carbon tax is enforced, the carbon tax should be lower price, okay, and then see how is the result, and the government will adjust the price, or I should say adjust the level of the carbon tax. Okay, and the ETS, it set the total quantity of emissions and allows the price vary. So it sets the cap, okay, the total allowable emissions, and the price of each allowance, each permit will vary according to supply and demand. Carbon tax is more simple, easier, and more flexible to embed, adjust, and administrate in lower cost, while ETS is more complicated to adjust, and there could be some administrative charge. Carbon tax can allow the participation of every company and individual. So even for every one of us, when you consume electricity at home, then the carbon tax can be charged according to the amount of electricity you consumed. Or maybe you buy some furniture, okay, for if those furniture has a higher carbon intensity, then you also need to pay for the carbon tax. Or even the A4 paper that you consume may include carbon tax. So for the carbon tax, it can be applicable to big companies, small companies, or even individuals. Applicable to importation activities, okay, like the import of goods, import of energy, import of electricity, import of materials, import of resources. So all these can enforce carbon tax. And for the ETS, very often for the power plants, large industry, large emitters only, okay, which could reduce emissions via controlling the usage of fuels. Difficult to cover importation activities. So for big companies and large emitters. Okay, as of April 2023, there are 73 carbon taxes or ETS in operation, with the share of global greenhouse gas emissions covered around 23%. Okay, so around 1/5 of the carbon emissions is in the market, okay, in the ETS market. Carbon price in most ETS are influenced by inflation. So their prices are determined based on the developments in other markets, including energy, commodities, electricity, etc. So price developments in these markets would affect the ETS price. Apart from inflation, ETS price is also affected by policy changes of the jurisdiction. So some regions may tighten the cap to align with the country's national emissions budget. Okay, so if one country have a higher target of carbon emissions, then they will reduce the cap, and then the carbon price will be higher. Okay, so you can see that the trend or the price of carbon or carbon tax will vary across different regions. Okay, global carbon price would need to rise in the long term to drive investment into climate neutrality at the scale and pace required. Prices would need to reach this by 2023. And here we have the trend of carbon pricing in 2023. And you can see that in some regions, okay, like in the EU, okay, in the Europe, the price would be around 100, okay, around $100 for every tons of carbon dioxide. Okay, and these value should be getting higher and higher after years. And it shows the evolution of the carbon price. So generally, it should be getting higher, okay, in except the Republic of Korea. Okay, lastly, about the carbon market in Hong Kong. So in Hong Kong, we don't have the ETS, okay, but the HKEX, the Hong Kong Exchange and Clearing Limited, published the Net Zero Guide in 2021. It introduced the essential steps for business to develop a pathway to net zero, aiming to help companies to understand their greenhouse gas emissions in terms of where they are now, where they want to get to, and how they get there. The HKEX has also enhanced the ESG reporting requirements. The 2020 enhancement required issuers to consider significant climate-related issues which have impact or may impact the issuers, or how issuers mitigate such issues. So these will be in the ESG report. So explaining the impact of the climate and how would be their measure, their strategies to reduce the emissions. So this has driven the HKEX listed companies to decarbonize and will likely boost demand of for carbon credits to neutralize unembedded emissions. So yeah, just the targets of the of Hong Kong, okay, to carbon neutrality. Okay, let's take a look at this example of a very simple example about market-based approach. So command and control and market-based approach. So let's say here we have two companies, okay, firm A and firm B. And for firm A, it will emit 4 tons of carbon dioxide. And for firm B, same, okay, also 4 tons. And if firm A needs to reduce their emissions, then for every ton of emissions, they have to pay $4. Okay, $4 for every ton of carbon reduction. And for firm B, cheaper, okay, just $2. They can reduce 1 ton of emissions. Okay, we have to calculate the costs associated with carbon emissions and emissions reduction for these two firms under 3 different policies: command and control, carbon tax, and the ETS. So the first one is command and control. So let's say the government requires each firm to cut their emissions to half. Okay, and everyone needs to comply. It is a regulation. All right. So for firm A, the emissions is 4 tons. So cut the emissions to half, then cutting to 2 tons. And the cost of emissions reduction is $4 per ton. So by cutting the emissions to half, so it means that they have to cut 2 tons, so the cost will be $8, right? And for firm B, also need to cut the emissions to half. So cut 2 tons, and the cost of reduction is only $2. So they only need to pay $4. All right. So for firm A, paying $8, reducing 2 tons, and for firm B, paying $4 only and reducing 2 tons. All right. So this is the command and control mechanism. And then for the carbon tax, okay, so the government sets a tax of $3 per ton. So you either reduce your emissions or you pay for the tax. So if you are firm A, the cost of reducing the emissions would be $4 per ton, and the tax is only $3 per ton. So for these two options, so you will not pay, you will not invest in the carbon emissions reduction, okay, because it's more expensive. So instead of reducing your own your emissions, you will just pay for the tax, right? Because the cost is cheaper. So for firm A, no reduction, okay, but it will pay the tax to the government. So for every ton, $3. So for firm A, emit 4 tons. So the tax would be 3 times 4, that is $12. Okay, $12, and then these are the total carbon tax for firm A. And then for firm B, the tax is $3 per ton. But for firm B, it is cheaper to reduce their emissions. It's only $2, which is cheaper than $3. So for firm B, they don't want to pay the tax. So they will spend $2 for reducing all the 4 tons of emissions. Then they will spend $8. Okay, so they spend $8 for reducing the emissions. And the overall emissions would be 4 tons for firm A because no reduction. And for firm B, reduced to 0 tons of emissions. Okay, so the total amount of emissions or total remaining emissions, okay, would be 4 tons, and earlier also 4 tons, total remaining emissions. And for command and control, the total amount of money would be $12, and then here also $12, okay, but this one is paid to the government. And then for this one is okay, this one also paid to the government. Okay, this is the command and, this is the cost of reduction. Look at the cost of reduction, investing in the technology. So firm A spend $8, firm B spend $4, reduce 4 tons or remaining 4 tons. And then for carbon tax, okay, also remaining 4 tons. Okay, but these money go to the pocket. This $12 goes to the pocket of the government, and this $8 spent on the technology. Okay, how about market-based, the cap and trade? So for cap and trade, the government introduced a fixed quantity of allowance, 2 tons. So it means firm A can emit 2 tons. Firm B can also emit 2 tons. And the markets allows buying and selling of allowances. Price of $3 per allowance result from buying and selling. So in the market, each allowance will be $3. Okay? So for firm A, which one will you use? So will you reduce your own emissions at a cost of $4 per ton, or you buy from the market? So of course you will buy from the market because it is cheaper, right? So for firm A, they will not spend the $4 for reducing their emissions. Instead, they will buy 2 tons of permits from the market. Okay, they can emit 2 tons because it is the quantity allowance distributed by the government, but the total emissions is 4 tons. So it means for firm A, they need 2 more permits. They have 2, and they now need 2 more permits. So they will buy from the market. So they will spend $6 buying 2 more permits from the market. And for firm B, it is very cheap to reduce their emissions. So they have 2 permits. And for firm B, they will reduce their emissions as far as possible, such that they can sell the 2 permits they have to the market. So they will spend $2 per ton to reduce their emissions and reduce 4 tons. So reduce all of their emissions. So firm B will spend $8 for reducing their emissions, and they don't need to buy from the market. And they can even sell the 2 extra permits to the markets and earn $6. Okay, so for firm B, they will pay $8 for reducing 4 tons of emissions and then selling 2 permits to the market and earning $6. So for firm B, they only need to pay $2, right? And for firm A, they need to pay $6, okay? And the total remaining emissions will be still $4. But you can see that in the cap and trade system, the total cost would be just $8, okay? So for firm A, they need to pay $6, and for firm B, pay 6 and earn 6. So they need to pay only $2. So in total, only paying $8 can already reduce 4 tons of emissions. All right? So by comparing these examples, we can see that for command and control, the cost implication will be the highest. And it also means that there will be some economical impact to the society. And for and for cap and trade system, the most cost-effective technology, the cheapest technology will be utilized first. And yeah, the allowance will be sold in the market. Okay, so I would like to explain the tutorial also. So in this tutorial, how many questions? 2 questions. Okay. So I think it's not too difficult, quite straightforward. So maybe after we have explained question number 1, I will leave question number 2 to your self-study. Okay, they are quite similar. Okay, question number 1. Company A has an annual carbon emissions of 100,000 tons of carbon dioxide equivalent. The cost of reductions is $5 per ton, and the possible emissions reduction is 10%. So it means that for this company, they can only reduce 10,000 tons. Okay, this is already the maximum. Okay, they can reduce as much as 10,000 tons of carbon dioxide equivalent at a charge of $5 for each ton. Okay, this is their reduction cost. And for company B, the annual emissions same, also 100,000, and the cost of reduction is more expensive, $15 per ton, and the possible emissions reduction same. Okay, also 10,000 tons. This is already the maximum. Okay, companies A and B have an agreement that if either company has emissions reduction in surplus, one company can sell the excess to each other at a price of $8 per ton. So you can see that it would be company A having the surplus because the charge or the cost of reduction is cheaper for company A Okay, so probably company A can reduce more of their reduction and then sell the extra credit to company B. Okay, now the government only gives 95,000 emissions allowance, which means 5% emissions reduction is subject to both companies. So they can reduce 10%, but according to the government cap, they need to reduce 5% only. Okay, each allowance represents the right of emitting 1 ton. Okay, and the market price is $10. Okay, $10 is cheaper than $15. So it means that for company B, they will not spend $15 for reducing their carbon emissions. They will either buy from the market or they will buy from company A, okay, because it is cheaper. And for company A, their cost of reduction is cheaper than the market price, cheaper than this $8. Those are the price that in the agreement between company A and company B. So for company A, they will reduce their emissions as far as possible. So they will reduce 10,000 tons and satisfying the 5% emissions requirement, and the extra 5% will be sold to company B or sold to the market. Okay, so determine the cost of emissions reduction for both companies if there is no emission trading mechanism. Comment on how the companies could do to get benefits from emission trading. So for this question, we have to consider two circumstances. One is without any emission trading, how much money the company needs to pay for reducing their emissions. So this is one condition. And the second is now we have the emission trading scheme. Then what is the economic benefits by company A and company B? So first of all, let's take a look at the condition when there is no emission trading. Okay, so you have to reduce your emissions even though the charge is very expensive. So for company A, they need to reduce 5,000, okay, because the government give you 5% emissions 5% allow 95,000 emissions allowance. So it means that company A and company B will need to reduce 5% of their emissions. And for company A, the charge is $5. Okay, so $5 and then reducing 5,000. So this is the total cost of emissions reduction by company A. All right, very straightforward. And for company B, it's more expensive, $15. So 5,000 multiplied 15, and we have 75,000. Okay, this is the charge if there is no emission trading. Okay. And the second part, now we have the ETS. Okay, we have the emission trading scheme, and company A will further reduce their 5% emissions. So apart from reducing 5,000, they will now reduce 5 more percent. Okay, and then they will sell the extra 5% allowance to company B at the price of $8. This is in the agreement. Okay, this is in the agreement that they will sell the surplus allowance to another company. And for company B, they will not spend $15, okay, because it's too expensive. So they will buy from company A or buy from the market. And because $8 is cheaper than $10, so for company B, they will buy from company A, right? So company B can buy the allowance either from company A or from the market. And company B decide to buy the allowance from the company A since the allowance sold by company A is cheaper than the market price. So $8 is cheaper than the market price of $10, right? So they will buy from company A instead. Okay, so earning on emissions reduction by company A would be 15,000. So they spend $5 for reducing their emissions. Okay, $5 for reducing 5,000, and then sell these 5,000 allowance to company B at a charge of $8. So they can earn this amount. Okay, this is the amount of money that can be earned by company A when there is ETS. And saving on emissions reduction by company B. So instead of paying $15 per ton of reducing the emissions, now they only need to buy from company A. Okay, so earlier this is the charge, but now you don't need to pay for $15 per ton, but only $8 per ton. So this is the amount of saving, or saving on emissions reduction by company B. So by enforcing or by applying the ETS, both companies will have some financial incentives, and the overall emissions is the same. Okay, so when there is no emission trading, reduce 10,000, and then when there is emissions trading, also reducing 10,000 tons of carbon dioxide. Okay, but there is financial incentives for both companies. All right, I think we don't have enough time to go through question number 2. And question number 2 is basically very, very similar to question number 1. All right, so I will leave it to you for your self-study. Okay, so please study the solutions of question number 2. All right, so we still have some time to 8 o'clock, so maybe we can take a short break. And then after that, like around 8 o'clock, we will start the test. Okay.